For more on all this, let's bring in SMBC Nikko Securities Chief Economist Joe Lavorgna. He also served as Special Assistant to the President and Chief Economist, of the National Economic Council during the first Trump administration. Joe, always great to see you. I don't know if you still have a Trump decoder ring or Rosetta Stone. Or what do you think he means ultimately by the things you said about interest rates today?
Well, a couple of things. One, I heard everything everybody said, and the tariffs are not inflationary and less immigration aren't inflationary, but we could get to that. What I heard the president say is, look, we have high inflation, which is why interest rates are high, and effectively to get inflation lower, rates will fall. Rates are too high because inflation's high. And that really is sort of the Fed's responsibility. The Fed cut rates 100 basis points, and yet long rates went up more. And it was due to risk premium associated with Fed policy where they should not have cut rates in November and December. Those were mistakes. It will make it more difficult for the Fed to get inflation under control going forward. So I put this squarely on the Fed. And that's how I interpreted President Trump's comments this afternoon.
Why do you think immigration changes in immigration policy and tariffs, why are they not inflationary? Can you just explain that to us?
It's very simple.
Very simply.
A tariff is a price level adjustment. Inflation is too much money chasing too few goods. Related to that, labor, wages do not drive inflation. Too many people working or too few people working has nothing to do with the inflation process. This is twisted Phillips curve ideology, which has not worked and not served the Fed well at all. So again, neither tariffs nor labor cause inflation. Too much money chasing too few goods, meaning it's a monetary phenomenon. Excess money and credit creation is what caused inflation.
Do you think that the average American, when they're faced with paying 10, 20, 25%, whatever it is, the surcharge is going to be on whatever goods they purchase as a result of tariffs, higher prices, that they will not perceive that as inflationary? They are spending more money on the same good, even just by perception.
No, because you're looking at the tariff in isolation. You're not assuming that there's any offset from a stronger currency. You're not assuming there's any offset from that cost being absorbed in the margin coming from whoever is exporting to the U.S. And you're also assuming there aren't lower energy costs because the tariffs are the incentive to bring production here. So you've got the tariffs, which are part of the process to incentivize companies moving here, in addition to low energy costs, business-friendly regulation, and corporate tax rates that go from 21% to 15% for domestic producers. In that world, that's a supply-side shift. That is not inflationary.
Hey, Joe, first of all, it's great. I think you're making arguments that I think are important and certainly in opposition to what a lot of people are saying, including, the IMF points out that if they just throw a blanket 10% tariff on the rest of the world, that's, whatever numbers you want to put on it, but different economists are putting different economic drag numbers on it. I care less about that. I care more about the comments you made about, this is really in the hands of the Fed, and you actually think that they actually moved too aggressively already. Talk about that. And do you think inflation's a problem? The bottom line here is you're right. The point is to try to identify, hey, inflation's too high. It needs to come down. However it happens, whether it happens, I don't know. But it sounds like you think inflation's a bigger problem. And if it is, I'm going to just say that I think equities are really on the wrong side of that.
So the market's excited about President Trump's policies. You see that in small business optimism. You see it in CEO optimism. But the Fed ultimately controls inflation. When the Fed cut 50 in September, which I was in the minority, I was of the view they were going to cut 50 because the labor market at that point in time looked very soft. I thought the economy might be weakening quite significantly. Maybe there was a political element to it. I don't know. But certainly from an economic perspective, one could have made the argument the Fed should have cut, and they did. But by the time we got to November and December, that no longer was the case. And therefore, I think that was a mistake that hurt Fed credibility. If you look at consumer expectations of inflation, Tim, they're still pretty high. So I think the expectation is, having gone through Trump 1.0 and having a good economy, GDP nearly 3%, inflation 2 or less, that will get the same outcome. But when you look at inflation expectations, they're high if you look at the University of Michigan data. And if you certainly look at various inflation metrics, even the CPI last week, the core people got excited about, that's still annualized on the month to 2.7 rate. That's still 70 basis points higher than where we were. So for the president's policies to be successful, which I expect them to do, we certainly need those energy costs lower. Energy is much more important to the economy than tariffs. It has a bigger weight, and there are significant indirect effects that come from lower energy costs, which obviously immediately will lower inflation and increase real wages. But the Fed, I blame a large part of this. We saw the Fed do extended QE for quite some time, and they were way too slow to hike, and I think they've damaged their credibility.